Welcome to Module 5, Section 10, where I will talk about analyzing the S&P 500. When we talk about analyzing the S&P 500, there are lots of different things to consider. On one hand, that can be very advantageous to us because we have lots of information. On the other hand, that can be a disadvantage because there's so much information out there, we don't know where to look or what to look for. Well, in this video, I'm going to share with you those things that I've found to be valuable, and I look at them every day, and I report on them in my daily, weekly, and monthly videos. This list that I'm going to show you is expanding and contracting all the time. Some analysis that we do works for a period of time, but then no longer seems to really tell us anything. There's other things that I'm discovering all the time that I add to this list, so it's ever changing. One of the benefits of studying a broad index comprised of high-quality stocks is that a lot of information is given off, and there are a lot of studies that are done on an index. This can be the Dow, this can be the NASDAQ 100, this can be small caps, mid caps. Where I'm going to focus is on the S&P 500. We get a lot of information from indexes that we don't get from individual stocks. And that can really help us a lot in our analysis. There are indicators that are unique to the indexes. These are indicators that we use on the S&P 500 that you don't see on individual stocks. This includes the S&P 500, and we can use all of those things together for our analysis. Decisions can then be made based on a broad range of tools that we use that I'll go through here, some indicators that we have, and our own analysis of price action and volume action. This can also be very daunting and can cause you to feel like you're being overloaded with too much information. If you are in that kind of a situation, sometimes you're afraid to make any decision at all. Usually what happens is we have the positive things that we look at and the negative things that we look at. And those exist every day, no matter what the current climate is like. What we need to do is weigh the positive and the negative to reach a conclusion. The idea is then to reach a consensus, and hence the consensus approach, which is the approach that I use for analyzing the market, and it's how I form the basis of my commentary and analysis in all the videos that I produce. So what are some of the tools that we can use to analyze the S&P? We have Intermarket Analysis. That was the section right before this, where we can look at all the different markets that are out there that have an impact on the stock market as well as the S&P 500. We use technical analysis, which is using charts, and that is a real focus of what I do. I have over 300 charts just of the S&P 500 that I look at every day, and then I look at those every week and every month. And that list is growing all the time as I uncover new ways to look at the S&P 500. I also use a thing called Dow Theory. It's been around a long time. It was developed by Charles Dow, and this mainly applies to the Dow Jones Industrial Average and the Dow Transports, or we call them the trannies. When I'm looking at Dow Theory, I also tend to include a third area of utilities, because utilities and interest rates tend to correlate very heavily. I take that same basic idea and then apply it to the S&P 500. We can look at the big cap index, which is the S&P 500. We can look at mid caps. We can look at small caps. There are transportation and utility indexes that we can also look at. Then how is the S&P performing compared to other indexes? And I do a lot of this, and I'm really expanding this area. How is the S&P doing with the Dow? How's the S&P doing with the bonds? How's the S&P doing with tech stocks? We can make a wide variety of comparisons using intermarket analysis and different comparison charts even within the stock market to get an idea of how is the S&P 500 performing. Is it outperforming other indexes? Is it underperforming other indexes? We can use that information and then say, okay, based on what we've concluded, we think the market is going to go up, and we can assume long positions, or we can assume short positions if it's going down. If we're heading into a real period of congestion or sideways movement, we might want to then implement sideways strategies. Some of these indicators are based on price, and a lot of them just use a calculation of past prices to come up with their current value. There are other indicators that we use that are based on volume, and there's a combination of the two. Price is the most important, and that's what we have to go with. But volume is also very, very important. What are some of the indicators that I look at? And I'm just going to list these here. I would like to bring up charts of each one of these, but this video would be about 4 hours long. And I just wanted to give a brief overview in this section of the different tools that I use. I look at advancing and declining issues, those that are going up versus those that are going down, where there's different indicators based on price, volume, as well as price and volume together. Price and volume indicators within the S&P 500, we can use those to determine is the market broad-based. There are 505 stocks in the S&P 500. If we have an up day in the S&P, does that mean that most or all of those stocks went up? If we have a down day, the inverse is also true. Is this just one or two stocks that are really carrying the load? Or are all of the stocks in the index seeing some kind of a move either up or down? We want to see, is some kind of a move confined to a limited number of bigger stocks? The really big guys, Microsoft, Amazon, Google, Apple, they have a tremendous influence on the S&P 500. If all those stocks are going up, the other 495 stocks may be going down, but yet the S&P 500 is going up overall. Now, the S&P 500 is a lot better balanced than the Dow. The Dow is 30 stocks, and you can have 29 going down and one stock going up, and yet the Dow is up overall. The same thing is kind of true when it comes to the S&P 500, but it is a little bit more spread out, so we get a broad-based view of the stock market. Another thing that we like to look at are a thing called sentiment indicators. What are people feeling? Are they positive about the stock market? Negative about the stock market? Are they indifferent right now about the stock market? And a lot of times we will follow sentiment. If everybody's happy, we can ride that wave. And the inverse is also true. Where we really look at this is when we're showing extreme readings. Is everybody euphoric about the stock market? That's a real warning sign to us. If everybody thinks, yeah, it's just going to magically happen, we want to look at doing the opposite of that. During market declines, if everybody gets pessimistic towards the market, nobody wants anything to do with the stock market anymore, that usually means we're getting near an end of that decline, and we want to be looking to do the opposite. It won't feel like the right thing to do because sentiment tells us that most people that are in the market are feeling really negative. And yet we're starting to look positive. This is where the mental analysis can really come into play. I do look at put-call ratios. Sometimes I use them heavily. Sometimes I think, is this really a good measure? But this is just looking at the number of puts, which increase in value as something goes down, and calls, which increase in value as something goes up. And how are they compared with each other? Because we can use options to hedge, where if you think something's going to go up, you buy a put that protects you in case it goes down and you were wrong about that. That's one use for options. We can also use options for capital gains. You can buy a call, and if that particular stock or index goes up, that option will also increase in value. The same is true with puts, although these increase in value as something goes down. So that gives us the ability to play both sides of the market. And I have lots of strategies that deal with options. What I look at each day is what's happening overall. Are more people buying puts? Are more people buying calls? Because unfortunately, people that trade options tend to be the least educated in the markets. And so we want to set ourselves up in a contrary manner with what most of the option players are doing. Not all the time, but when we're looking at extreme readings in one direction or the other. Another area that we watch closely is a thing called volatility measurements. You may have heard this called the VIX or the fear gauge. When that gauge really goes up, that means there's lots and lots of fear. When that gauge goes down, that means we're getting into an area of complacency where there's not much fear. Again, we use this in a contrary manner. When there's a lot of fear, we're looking to get in long. When there's a lot of complacency, we're looking to get out long and possibly get in short. And then inflows and outflows. Do we see a lot of money going into mutual funds or coming out of mutual funds? And the same thing can be true with ETFs. Is there a lot of money flowing into particular ETFs or coming out of ETFs? A lot of times we'll go with the crowd during a move, but we look at this during extreme readings. Then another area is optimism and pessimism indicators. If people are really optimistic, again, that can last for a period of time. And we might ride that optimistic wave. But sometimes the party gets close to being over and we want to leave early. The other thing is also true, where people get very pessimistic about things. And so that's when we start to say, maybe it might be time for us to think the market is going to go up. There's also a thing called the McClellan oscillator. This was developed years ago and has become a real staple indicator. The McClellan oscillator was first based on the NYSE composite. Those are all of the stocks on the New York Stock Exchange. Well, we've gone beyond that now, and we know how to calculate this, and so we can apply this to the Dow. We can apply it to the NASDAQ or the NASDAQ 100. Well, we can also apply it to the S&P 500, and that's what we do. The McClellan oscillator is a little more short term. If we have a down day, usually the McClellan oscillator will decline. If we have an up day, the McClellan oscillator will go up. Where we look at changes is when the McClellan oscillator goes below zero or comes above from zero. Another longer term indicator is called the summation index. What is the McClellan oscillator doing over a longer period of time? So we can use the McClellan oscillator for very short term trends and then the summation index for longer term trends, or in my case, I call them intermediate trends, weeks to months. So this can go on for an extended period of time. This helps us to define the trend on a short-term basis and an intermediate-term basis. Then I also have a number of price momentum oscillators. These were indicators developed by Carl Swinland, who runs DecisionPoint.com, and also himself and his daughter contribute to StockCharts.com. These are other ways of being able to analyze the momentum based on volume and based on price. Another thing that I do is what I call intraday analysis. Even though I'm not a day trader and I don't get in the morning looking to get out 10 minutes later or 6 hours later, I still watch things very closely. You would be surprised of how much insight you can get just by watching things. And I have another section where I talk about market observation and the different things that I go through that I look at when the market is open as well as when the market is closed. Each day, both the S&P 500, that's the SPX, and the SPY, that's the ETF, based on the S&P 500, are analyzed while the market is open using real-time data. Some of the intraday charts that I include are the 10-minute chart, and that's probably the one that I watch the most. You get rid of a lot of the noise that a 1, 2, or 5-minute chart may give you. It's a little bit quicker than a 15-minute chart, and I've just kind of settled on the 10-minute chart after watching this for years and years and years. You can also bring up a 30-minute chart, as well as a 60-minute chart. I do bring those up, but I don't follow them as closely. I look at the 10-minute the most, and then I just use the 30-minute or 60-minute just to confirm what is happening, or the 30 or 60-minute chart may be telling us something that the 10-minute chart is not. Other time frames are also used when deemed applicable. There are times when we're going to have a Fed announcement and they're going to decide on interest rates. I'll switch over and use a 1-minute chart just because we're shooting all over the place and it's kind of fun to watch. But if you watch the market while it's open and you use a 15-minute chart and you're comfortable with that, go with it. I have my reasons why I look at these charts, but you might have your reasons why you use a different time frame. What I do for intraday analysis is I'm trying to look at support and resistance levels. These are called pivot points, and this is one of the coolest things. And this is why I like the 10-minute chart the best. Before the market even opens, these pivot points are calculated. And so we can plot those on a chart. And especially on the 10-minute chart, I've observed with the S&P 500 that a lot of the algorithms and program trading and different computerized methods out there, they like to use these too. And we will go right up to a pivot point for that day, stop, and then turn it around and go in the other direction. Or if we break through it on high volume, that tells us that the move is really strong. If we're falling, we have support levels where we'll go right down to a support level that's predefined and bounce up off of that. Now, this doesn't always happen, and you can't bank everything on this, but you would be surprised to see how many times this does happen. When I do my daily videos, I usually start with a 10-minute intraday chart, and I say, okay, here are the support levels, here are the resistance levels, and look how we came right up or came right down to one of those levels, found some support and bounced up, or hit resistance and came down, or we stalled at that point. We can also use these different pivot points in other markets. If the Dow's really steaming in one direction and it hits one of its pivot points, that might slow things down, which then comes over into the S&P 500 as well as other indexes. And the same thing is true with the NASDAQ 100, small caps, mid caps, but I really focus on the S&P 500 the most. Usually what I'll do, if we're going up in a direction and we seem to stall or hit support and we're not at a predefined level in the S&P 500, then I'll go look at some of the other indexes. Also during the day, we want to look at the intensity. How strong is something? And the velocity. How much power is behind a particular price move? If we see price going up and volume really dropping off, that doesn't produce a lot of confidence. We need to see an increase in volume for it to continue, or we can look at things pulling back, if not actually reversing. Another thing that I look at is a thing called gap analysis, and I talk about this too in the stock market observation section. Because we live in a global economy and in global markets, there's the US session, and when that closes, within a short period of time, we start to have the after-hours session, and then that bleeds into the overnight session, and then we have the pre-market session. So even though stocks trade in the US during the day, other things are trading when the market is closed, and that has a direct influence on what will happen with the S&P 500. What I usually do before the market opens is I will make a blog post that's available to the members of the program, and I'll say we're looking to open up, or we're looking to open down, or we're looking to open pretty much unchanged. When we have a real gap to the upside or to the downside, that tells us a lot. One thing that I recommend that people never, ever, ever do is trade the first hour to hour and a half in the markets. And if you think about this, it does make some sense. Let's say it's Monday morning and we're looking at the market opening positive. Well, think about what has happened since the market closed on Friday. Everything shuts down Friday afternoon, and then it picks up again late Sunday evening. We start into the Asian markets, it goes over into the European markets, and then we have the open in New York. That's what's happening with prices in the stock market. What is happening in real life? You have a lot of people who sit down over the weekend and make their decisions to get in, to get out, and they may make this decision on a Saturday morning and say, okay, I'm going to get more into that mutual fund. I'm going to buy some more of these stocks, and they enter their order right now. Well, even though the order is entered on a Saturday morning, it's not going to be executed until the open on Monday. And you have millions and millions of these orders that are backlogged that are looking to be executed that may not have any logic behind them other than, okay, it's time to get in. I got paid on Friday. I'm putting my $100 into the market today, and so I'm going to buy. And you have a lot of people doing that, and that could really push prices up. Well, that's not necessarily based on any kind of market logic. And so we want to give some time for that noise to dissipate. There's not a lot of logic going on there. It's just orders being filled. Wait until a little later on to get more of an evaluation of where we're headed for that day. Another thing to watch out for, if we have a real gap up, look for a fade. People selling into strength. From the close on Friday to the open on Monday, there might be a real large discrepancy between those prices. And if that's to the upside, you may use that as an opportunity to sell. And a lot of people do that. They're selling into strength. The inverse of that is also true. If we're gapping down for the open, you may use that as an opportunity to buy. We let all of that settle, and then we say, okay, this is what it looks like is going to happen. Now, there are a significant number of times when most of the move is right at the open, and then we spend the rest of the day just kind of drifting. That can tell us some important things too. If it's in our favor and we're looking to get in, that can give us confidence to initiate a position. Or if prices are moving in the opposite direction of what we want, we may pull back and say, okay, let's wait and reevaluate things and look to see how things are tomorrow. There's one thing that I like to use, and I've mentioned this in other sections, that's a final variable for either entering or exiting a position. Mostly this is for entering. You can get out of a position whenever your profit target is met. Getting into a position, especially if you're in the short term or intermediate term, that's pretty much going to decide your success or failure right off the bat. My personal philosophy and what I teach people to do is enter a position if the market is moving in the direction of the strategy. If you have a bullish strategy, which means going up, you only want to enter in that position if the market's actually going up. You want to jump on what's already happening. It makes some sense to me from a logical standpoint, but no sense from a stock market standpoint to say, okay, I want to buy a stock at 10. I see where it's fallen to 9. Now I'm getting it on sale. No. You have a stock that was at 10 and has now declined to 9. If you want that thing to go up, are you sure it's finished declining? It may continue to decline after you get in, and now you're seeing a loss right off the bat. You're battling your emotions. You hit your stop losses, and suddenly, poof, what you thought was a very good investment or trade turned out to be a loss. So what I've decided to do, and what I've done for many, many years now, is trade in the direction of the strategy. If the market's going up and you're looking to go long, fine. If we see an opposition to that, hold off. And then enter as close to the close as possible. Now, some of you work jobs, you're not near a computer, you can't really do this. You can only enter your orders in the evening, or maybe you work with a spouse and they're actually putting in the orders. Everybody's going to be a little bit different. But the ideal approach is that you want to enter as close to the close as possible. Now, that doesn't work with all strategies. There are other strategies that I teach that are based on time, and we need that whole day's time to basically erode the value of certain options that we've sold. I'm talking about directional strategies. There's an adage on Wall Street that says the amateurs open the market, the professionals close the market. Now, there are exceptions. We can see a big buy or sell program come in right at the close. We can see readjusting, especially at the end of the month or the end of the week. But largely, we want to get as close to the close as possible because we've had that whole day to watch things unfold and to gain confidence in our particular position. What are some of the S&P 500 studies that I look at? And I'm just going to list them here, where I go through charts in the videos as well as in my additional classes that I offer. One thing that I look at are new highs versus new lows. Over the last 52 weeks, 1 year, how many stocks are hitting new highs today? If that number is really strong, that shows real health. If that number is weakening, that gives us some warning signs. How many are hitting new lows? If we're really going down and stocks are hitting new lows day after day after day, we may not be done with that downward movement yet. I also look at a lot of relative strength studies, and this is where I'm really expanding the charts that I look at, where I'm saying, okay, how's the S&P doing compared to tech stocks? How's the S&P doing compared to bonds? And I'm actually looking at the strength of the S&P 500 relative to other indexes or other markets. Don't get this confused with a thing called the RSI, or the Relative Strength Indicator or Index. That is an indicator that we use as part of technical analysis. And it's really kind of misnamed because relative to what? It's relative to itself. So I don't really like the name of that indicator. It's really more of a momentum oscillator that we use to help determine overbought and oversold indications in the market. What I'm talking about is comparing one area of the market with another area of the market. Then I look at the different strengths or weaknesses in the sectors. There's 11 different sectors, and I have a section that you probably have already gone through by now that talks about the different S&P 500 sectors. What sectors are strong? What sectors are weak? Are most of them up? Are most of them down? Then I also make a lot of comparisons with other indexes. If the S&P is up, but the NASDAQ is down and the Dow is down, we might want to watch that. If we're having a really strong day, we'll see the NASDAQ 100, the NASDAQ, the S&P 500, and the Dow all going up at the same time. And there are periods of time when some of the other indexes, like small caps and mid caps, they will either outperform or underperform the S&P 500. And we watch for those things. I also use a lot of overbought and oversold indicators. Overbought means we've gone up too far too fast and we're looking at a pullback. Oversold means we've declined too far too fast and we're looking at some kind of a bounce. Where we really take an interest in this is when a reversal or a bounce turns into an actual change of trend. Then I look at a lot of different oscillators as well as a lot of standalone indicators. And some of these indicators I developed myself. And I'm testing out all kinds of indicators all the time. I'm constantly doing research to say, okay, what's another way we can look at this? Some of these indicators turn out to be garbage. Some of them turn out to be very useful. Then I look at a lot of performance studies, both in the short term, that's days to weeks, and then the intermediate term, that's weeks to months, and then long term is months to years or even decades. Then I look at multiple time frame studies. I'm looking at daily charts, I'm looking at weekly charts, I'm looking at monthly charts. I don't use a lot of yearly charts, but I have a few that I do look at. Then I look at trend and momentum studies. Trend, what direction are we going in, up or down? Momentum is more shorter term. If we have an up day, generally the momentum is up. If we have a down day, generally the momentum is down. I have a lot of different moving averages that I study. Really short-term moving averages and very, very long-term moving averages. And then some of the trend condition studies. And I have some other videos on the channel. It's not part of this course where I talk about, are we trending? The S&P 500 can spend a significant amount of time not really going anywhere. We're really chopping around. We might have a bias to the upside or the downside, but there's no real conviction behind the trend. We implement different strategies during different times. If we have a strong trend, we implement trend-based strategies. If we're in a choppy environment, then we implement sideways strategies. This is usually the first chart that I look at every day. Some of the additional studies that I look at are a thing called the bullish percent index. If you're familiar with a thing called point and figure charts, they're not based on time, they're based on price. When we have a lot of buy signals in the S&P 500, those are all measured together and produce a thing called the bullish percent index. If we see a lot of point and figure buy signals in the S&P 500, that is positive. If we're seeing a lot of sell signals, that is negative. I also look at earnings and dividend studies. How are the earnings going up over a period of time? Are they going down? Are they keeping pace with prices? Or are prices getting above or below the trend of earnings? As well as dividend studies. These are profits that are paid to shareholders who own that stock. Are the dividends going up or are they going down? Then I look at a lot of various charts, and I call these chart studies. There's a thing called a Kegi chart, a Renko chart, and a 3-line break chart. These take the price and just look at them in a little different way and go, I didn't see that on a bar chart or a candlestick chart. I'm seeing something here on a Renko chart that I didn't see otherwise. Then there's a thing called parabolic SAR studies. That helps us to determine the trend. It's color coordinated. It's really kind of cool. And it just kind of confirms what direction the market is going in. This particular study itself could be a standalone system. If I remember correctly, the SAR is an acronym for stop and reverse. Then I look at volume and different participation studies. We might have an up day, but if a lot of people aren't really participating, does that really show a strong move? If we're seeing a down day and a lot of participation, that can mean a conviction or even a washout where everybody's getting involved at the same time and things may exhaust themselves and turn around and go in the other direction. We don't use these in isolation. We use them in conjunction with all of the other indicators. Then Fibonacci studies. If you know much about mathematics, there is a ratio in nature that tends to measure how things are built in the universe according to mathematics. We can also apply that to human behavior. I use these and put these on a lot of my charts, but I just use them as one tool, where some people will rely on these exclusively. Then another thing called Elliott wave. I do follow Elliott wave studies, but I'm not a big fan of Elliott wave, mainly for one reason. It is very subjective. You can have 10 different Elliott wave people looking at the same chart and they will all come to different conclusions because they're all using their own opinions and their own ideas to interpret what the chart is actually saying. where we want things to be more objective. We just want to look at something and go, yeah, that's clearly an uptrend, or that's a downtrend, or we're going in a sideways trend right now, where there's very little ambiguity. I subscribe to some blogs and newsletters for people that base things on Elliott waves, and man, they tend to be a very negative crowd. They're always predicting doom and gloom. Some of these guys that I follow have been predicting doom and gloom for about 20 years, and they've been so very, very wrong, and they're so convinced that they have the right answer. I've gotten to the point where I use them as a contrary indicator. Sometimes they're right, and that justifies them having some subscribers to their blog or to their newsletter. But when it really comes to the point of making a decision, if they're saying crash, 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 I'm saying, okay, what can I find in the market that's positive? And then I weigh those two things together and I go, the positive aspects really outweigh the negative aspects. I don't think this person is correct in their analysis. I'm going to use these other tools instead. Another problem with Elliott Wave is it's great. It's wonderful. It's perfect for telling you what's already happened. But that doesn't do us any good. We can't look at a 5-wave up or a 5-wave down or a 3-wave this or a 3-wave that. We might be wrong in our interpretation of that chart. And so I tend to exclude it. I used to have this monster piece of software that was Elliott Wave based. And it really gave me some bad signals at the time, in real time. It was perfect looking back through history and telling me what was going on. But that doesn't do me any good. So that's where I come out on that. Then different algorithmic studies that I do, just basing things on numbers, basing things on different ways to calculate things. And then sector analysis studies. During different times of the economic and business cycle, sectors within the S&P 500, some will perform better, some will perform worse. When we really like it is when all of the sectors are acting more in concert with each other. I look at some broader market studies as well. These are other indexes. These can include ratios between the S&P 500 and another index. I also look for convergences, and I talked about this a little earlier. If the Dow is hitting a new high and the NASDAQ 100 is hitting a new high, and now we see the S&P 500 hitting a new high, that's a convergence. But if we see where the Dow is hitting an all-time high and the transports are not, that's a divergence. And we look for positive and negative divergences within the stock market and across a number of different indexes. It doesn't necessarily mean we act upon these convergences or divergences. We just take note of them and say, okay, we're seeing some warning signs or we're seeing some confirmation. I look at domestic stocks within the U.S. as well as studying foreign stocks and stock indexes. I'll look at the small caps, the mid caps, and large cap indexes. Then there's a thing that Dick Arms came out with a long time ago called the Arms Index Study as well as Trend Analysis Studies. I won't go into a lot of that right here, and I don't use that really heavily, but I do look at it, and when it's telling us something, then I make a note of that. Then different Dow Theory studies that I talked about a little while ago. Different advanced decline line studies. Are most of the stocks going up? Are most of the stocks going down? That will give us a look inside the market. We not only look at the broad market, we look in the S&P 500 itself. And if most stocks are going down, but yet we're hitting new highs, that should be a little bit of a concern. If we're hitting new highs and most stocks are also going up, that gives us confirmation. Then tick analysis studies. A tick is if you were to freeze a moment in time, if there were more sales than buys during that period, the tick would be negative. If there were more buys than sells during that instance, the tick analysis would be positive. So we're looking at the buys versus sells. If we see the tick really going negative, a lot of times we'll see price follow that, and the inverse of that is also true. And then volume analysis studies, and I have a whole section that I go through because I really do focus on volume. Even though price is most important, volume can really give us some good, solid insight. And then I look at world bond indexes and comparisons, as well as world stock indexes and comparisons. So what is the goal? The ultimate goal is to use all of this information together to reach the best decision possible. That's where I differ from a lot of other folks. I'm looking at as much information as I can find, using all of that together, and then I say, okay, this is where we're at right now. And based on that, this is the probability of where we're going to go tomorrow. And then tomorrow I do the same analysis again. And I just look at it day after day after day. And sometimes I get the same conclusions drawn day after day after day. And we have a trend either going up or down. Some days will reinforce a previous conclusion. So we're looking good on Monday. I analyze things on Tuesday, we're still looking good. Then I analyze things on Wednesday, we're still looking good. So it starts to print a story of what's actually happening. That's why I make the daily videos. That's why people that are in the short-term version of my program, they have to watch the videos every day. If you think you're just going to watch part of a video or just watch 1 or 2 videos a week and you are making decisions based on what's happening every day, you're missing a lot of the story. You need to really figure out what's happening. Other days will require waiting for more information to provide a clearer picture. It will never be crystal clear. Any given day will have positive things and negative things. It will never be cut and dry. Sometimes it's so cloudy that we're like, we've got a big Fed meeting tomorrow, or there's some report that's coming out this week. Let's fall back a little bit and see what happens and see how the market reacts, and maybe we can make a better decision then. Don't be afraid to wait. So yes, doing nothing is also part of investing. Now, if you're longer term, you're in the market, and that doesn't mean you're doing nothing, but you may wait to add to your investments, or you may wait to sell. If you're shorter term and you're looking at initiating something new, you may want to wait a day or two until things are a little more clear as to what you should do. The main objective is to not get caught off guard. When I looked at developing this skill for myself, this was the biggest hurdle. It seemed like there was always something coming out of left field that caught me by surprise. And so I just said, all right, I'm not going to let that happen anymore. After watching this for a long period of time, you tend to not really see anything new. There are different events, but how the market reacts tends to be the same. The idea is to understand what's happening right now so that if it goes against you or for you, it's not a surprise. You're like, okay, I saw that coming, and it actually happened that way. A plan should be developed for all 3 scenarios. There's only 3 things that can happen in the market. It can go up, it can go down, or it can stay the same. The only thing that moves is time. So if the S&P 500 is going up, what are we going to do? If you're in short positions, that might make you a little nervous. Or if you're looking for the market to go down and it turns around and goes up, what kind of a plan are you going to have for that? If any. What are you going to do if things go down? And that's how most people are positioned. They want the market to go up, and where they start to run into trouble is when the market ends up going down. What are you going to do about that? You're just going to hope and pray that everything works out to your advantage? Or are you going to learn some of the tools that you can implement and actually put those into your plan? And then what are you going to do if things go sideways? There are a lot of really good strategies out there that allow you to benefit from sideways action. You may not be making a lot in your trend-based systems, but you can make really good returns in some of the sideways strategies. So that concludes Module 5, Section 10, and I will pick up with things again in Section 11.